by way of introduction, again, welcome everyone to the webinar today, our State of the Market, quarterly State of the Market webinar. I'm Wade Watkins. I'm an advisor with Squire Wealth Advisors. We have with us today Brian Haywood, who is with Focus Partners Wealth. And he's a firm that we partner with the firm that we partner with on a lot of the research and market strategy and things. And so he's taken some time out of his schedule to come and spend some time with us and talk about the state of the market. We appreciate Brian being here. If you have any questions, there is a Q&A tab icon up at the top of the screen. You can click on that and submit your questions there. We'll monitor those throughout the webinar and may break in a few times and answer questions throughout. If not, we'll save some time for question and answer at the end as well. We will record this and share it afterward as well. So if you're maybe a little late coming in and you missed part of it or want to rewatch part of it, you'll have that opportunity. So with that, I will turn it over to Brian and let him go.
All right. Thank you, Wade. And once again, thank you so much for taking time out of your busy day to attend. Really appreciate it. So as you can see, we're going to talk about the state of the markets. And when we say that, what we're going to go through is we're going to give a brief update on where financial markets sit after the second quarter, give an update on the current economic conditions, talk about inflation and Fed policy, dive a little deeper into international diversification, and then last but not least, discuss some of our liquid alternatives, the performance and why we think they're a valuable tool in a portfolio. So without further ado, let's take a look at what markets did year to date. So despite all of the kind of turmoil we saw in the second quarter from, it seems like ever-changing trade policy here in the US, we actually have had a pretty good first half for US stocks. The US stock market is up about 6%, 5.8% through Q2. US large value stocks were pretty much up in line with the market, up 6%. Unfortunately, small value stocks trailed a little behind, being down 3.2%. But shifting to international markets were on fire in the first half of the year. You can see international developed stocks are up 19% year to date. Large value stocks in the international side are up about 22%. Small value up about 21%. And then emerging markets brought up on the international side, brought up the rear, but still up a very healthy 15%. So obviously a very, very good kind of first half of the year. And honestly, if you would have come to me on April 3rd, the day after the tariffs were announced, and told me what the stock market would be sitting at today, I would not have believed you. So I think it's just a good reminder that it's very, very difficult to predict what markets are going to do. So staying invested and staying disciplined is always the best course of action in our opinion. Now, moving over to fixed income, you can see fixed income has had pretty solid returns so far in 2025 as well. The U.S. aggregate bond index is up 4% year to date. Intermediate treasuries right in line with the broader index, up 4%. And then U.S. inflation protected bonds up slightly more at 4.7%. So, a good first half of the year for fixed income. Turning over to a couple other asset classes that we generally watch closely, global real estate, commodities. Again, decent half of the year with global real estate being up 4.2% year to date, and commodities up about 5.5%. So all in all, a pretty good first half of 2025, especially considering international markets and the outsized returns they had in the first half of the year. Now, pivoting over to the economy, I'm going to divide this up into kind of two parts. We're going to first have kind of the hard data, inflation, unemployment, these types of numbers. And then the second part, we'll look at some of the underlying soft data, things like consumer confidence, those types of metrics. So looking at the economy, the US economy, although it is showing some slight signs of slowing, it's still in a pretty good shape. You can see annual inflation, it was 2.4%. Now, that's the May number. Unfortunately, I had to finalize these slides before I could get before the June number came out. It actually ticked slightly higher in June to 2.7%. So saw a little bit of a rise there in June. Now, could some of that be tariffs? Possibly, but looking underneath the hood, there's no real kind of smoking gun that would say, hey, this is tariff related. So we're still not sure if we've seen all the effects of tariffs or if maybe there's um, still some more effects from tariffs to come in the data moving forward. So only time will tell there. But at the moment, we have not really seen tariffs inflate the inflation rate much. Now, as far as unemployment, unemployment remains very, very low. It remains at 4.1% as of the latest number. And you can see there, it's kind of hovered around that 4% area since kind of late 2021, early 2022. So the labor market still remains fairly strong. Pivoting over to the jobs numbers, we're still also getting fairly solid monthly job growth. So the latest number came in at 147,000 jobs added. So it's kind of, although it's slowed from its pace in 2022 and into kind of early 2023, it's still reliably producing 100 plus K jobs on a monthly basis, which is I'd say pretty solid job growth there. Now, pivoting towards real GDP growth, we actually saw negative GDP growth in the first quarter. Now, although on the surface that might look bad, like, oh, well, the economy is clearly slowing, there was kind of artificially pushed lower. And the reason for that is one of the components of GDP is import exports. So when we import a lot, that takes off that GDP number. So what we saw in Q1, as it became more and more apparent that tariffs were coming, a lot of companies tried to get out in front of tariffs and imported a number of either finished goods or materials to get in front of that prior to the tariffs going into effect. And so we had, one of the largest quarters for imports in, I believe, more than a decade. And so that pushed that number kind of artificially low. You can see second quarter, we're expecting a good rebound. We don't have the final data yet, but based off of the Atlanta Fed's estimate, we would expect to see real GDP growth of about 2.4, 2.5% in Q2. Now, although that looks like a nice rebound, we are seeing some slight signs of slowing. If you take out some of the more volatile components of GDP growth, trade being one of those, imports, exports, inventories, and government spending, and you just get down to kind of real final private demand from final citizens, it has shown that it looks like it's slowing. It went from about 1.9% in Q1 and it's estimated to be around 1% in Q2. So, while I'm not forecasting doom and gloom, just saying it looks like there is some slight slowing, which would make sense given the trade policy currently in place. Now moving over to kind of the soft data, and this is where there are some a little bit more concerning signs, specifically when we look at consumer confidence. So in the Conference Board's latest consumer confidence report, it declined in June and it erased half of the gains we saw in May. There was a little tick up in May, but June was not a great month when it comes to consumer confidence. Part of the consumer confidence report is an expectations index, and it's basically it asks consumers to rate the short-term expectations for kind of inflation, job growth, economy, so on and so forth. And that's below kind of the recessionary level of 80. It stands at about 69. So, the consumer is a little bit more pessimistic, although we haven't seen that kind of borne out in the hard data yet, or maybe it won't end up creeping in there. The report found that the confidence drop was broad-based, so it affected all ages, income groups, and political affiliations. Unsurprisingly, consumers said tariffs are their main economic concern, with other sources of unease being rising costs and then the possibility of recession. Another soft data point to look at is the Business Roundtable. They do a survey of a number of top CEOs of Fortune 500 companies to get their outlook on the economy over the next few quarters. And that index fell to coincidentally 69 as well, and that's well below its historical average of 83. So when you have consumers that are a little bit more pessimistic, and obviously business leaders more pessimistic, that's not a great recipe for growth. Not saying that that's recessionary, but that could mean looking forward, we might see consumers start pulling back on purchases, which obviously would drive down GDP. And also, obviously, if you're a business owner, a CEO, if you think the economy is not on the most solid footing, you'd expect to kind of pull back on any kind of capital expenditures. Maybe you're not going to green light larger projects. Certainly, you're going to take a harder look at hiring. Maybe you put on a hiring freeze, or you delay hiring that you would have normally done in kind of better market conditions. So those are a bit concerning, but at the moment, we haven't seen anything in the data that leads us to believe that any kind of recession is imminent. And also, given what the market has done, the market is not expecting any kind of downturn as well. You would expect, to see a decent sell-off if there was a recession likely in the future. So markets, obviously are forward-looking, and given their performance, it does not look like they're anticipating a large slowdown in the U.S. economy in 2025. Pivoting over to inflation and Fed policy. Well, I know I showed you a chart of CPI a couple slides ago. I wanted to chart this measure of inflation, PCE inflation, personal consumption expenditures inflation. And the reason I'm charting this is the Fed's preferred measure of inflation. Now, the reason the Fed prefers this measure of inflation versus CPI is CPI is a static basket of goods. Now, obviously, as consumers, we don't buy necessarily the same things all the time, especially if a price of a certain commodity is very high. We might switch our behavior and transition to an alternative. So CPI doesn't account for that, whereas PC accounts for those changes in taste. So it accounts for what consumers are actually buying and the varying shifts in product purchases. So you can see here, looking at headline PCE inflation, it's about 2.3%, so slightly lower than CPI. And then if you look at the core number, it's 2.7%. And remember, the core inflation, what that is, it's the headline number, but then you remove the more volatile food and energy components. So you can see there, it's still above the Fed's 2% target, but we're still seeing moderation in the inflation rate. So although it's ticked up slightly recently, it's still in a positive trend, and it looks like it still will hopefully over time dip below the 2% that the Fed's kind of targeting. Now, speaking of the Fed, given all the data we've seen, what are they expecting to do? Well, at their most recent meeting, the Fed produced what they call their summary of economic projections, And one of the things that they note in there are all the various Fed members, their expectations for where the Fed funds rate is going to be at varying intervals. So looking at that data, the Fed members are expecting that they are likely to lower interest rates roughly 50 basis points before the end of the year. So likely two cuts, I should say, before the end of 2025. The market basically agrees with them, looking at kind of Fed funds futures. They're also expecting two rate cuts this year. It looks like the first cut is most likely going to be in September. We actually have a Fed meeting next week. Highly, highly unlikely we see any movement from the Fed next week. But smart money is kind of looking at, September being the first spot where we would expect a rate cut. But obviously the Fed is very data dependent right now. So if we would start to see inflation heat up, if we would start to see some, in that case, we would probably see the Fed maintain rates where they are. If we're starting to see some poor economic data, we would start to see the unemployment rate start ticking higher. Maybe that would spur the Fed to move rate cuts forward or increase the number of rate cuts before the end of the year. Now, with that said, the Fed is, based on what Chairman Powell has said, is being rather cautious. So, after the most recent meeting in June, Chairman Powell noted the following things in his press conference: said policymakers are well positioned to wait before moving further on rates. And he also mentioned that we're beginning to see some effects of tariffs on inflation. So, kind of me reading between the lines, the Fed doesn't, in my mind, doesn't need to be in a rush to lower rates. The economy still seems to be on solid footing. Unemployment is low. Job growth is still good. We're still seeing an expanding economy, although it seems to maybe be slowing just a little bit. But we're definitely still seeing inflation above the Fed's 2% target, and we're also, the Fed is still worried about the upside of inflation. They're still worried about potential impacts from current trade policy that might continue to bleed through. So I think the Fed is going to be probably overly cautious in their approach to lowering rates, and they're going to need further proof that either tariffs are not going to increase the inflation rate, or potentially we're starting to see the economy, slowing more than they'd like. So that's where we'll kind of sit with Fed policy. Still anticipating two rate cuts before the end of the year, but certainly based on data that could get pushed further into the future, or it could get moved up depending on what happens going forward. Now, I want to dive into international diversification. I want to spend a little bit of time on this because it's been a pretty hot button issue over the last, I'd say, 5 to 10 years. And the reason for that is US markets have performed exceptionally well relative to international markets. International markets have lagged behind US stock market for the better part of a decade now. So that's led a lot of investors to ask, should we continue to allocate to international equities when the US stock market seems to be the place to be? Well, taking a look at a few different things leads us to believe that we still think a sizable international equity position is warranted. The first is just looking at the world market cap. So the pie chart you see on this slide is as of the end of 2024. And as of that date, the US stock market was roughly 64% of the world's market cap, with international developed and EM making up the final 36%. So it's hard for us to just say an investor should just completely ignore basically 1/3 of the world's market cap. We would say that's foolish. And this alone should argue for a meaningful allocation to international equities. A couple other things to mention. First is we have seen international equities underperform US equities for an extended period of time, but that is not unusual looking at history. So what I've charted here is in blue are the annualized performance of US stocks during these various decades. The yellow bar is international stocks, and then that purplish pink bar, if it's negative, that means international stocks outperformed, and if it's positive, that means US stocks outperformed. So you can see all throughout the 70s and 80s, we had international stocks strongly outperform US stocks. So if you were a investor in late 1989, I would imagine you are having the opposite conversation that we're having with a lot of clients right now in that, hey, why should I be in US stocks? Why shouldn't I be more in international stocks? Because international stocks have had such great returns over the past 20 years. Well, look at what happened in the 1990s. If you would have gone heavily into international stocks, you would have missed out on the ridiculous bull market we saw in US equities in the 1990s, where US stocks outperformed international stocks by 11% annualized. So you would have missed out on that huge outperformance from US stocks. But look, in the 2000s, again, it flipped. Now, I will grant that the 2000s was not a great decade for equities in general, as you can see, but there was outperformance from international stocks versus US stocks. And then since then, it's flipped again. We've seen strong outperformance from US stocks over international stocks. So just want to show that this is not an unusual thing to happen for one side of the market to dominate the other for an extended period of time. Now, what does this mean looking forward? Well, obviously, we can't say anything definitively, but what we can do is we can look at valuations to give us an idea of what we expect these various markets to do moving forward. Now, one of the easiest ways to value whether it be a stock or a stock index is to look at its PE ratio. So that's its price to earnings ratio. And the higher that PE ratio is, the more highly valued that stock is. And so what I've charted here is the ratio, it's going to sound a little funny, but the ratio of PE ratios of US stocks versus international stocks. So you can see as of the end of May, which is the most recent data we have, you can see that number at 1.81, which is outside of the very recent past, the highest it has ever been. So said another way, US stocks are more highly valued versus their international counterparts than they virtually ever have been in the past. I mean, even more highly valued than they were kind of at the height of the tech bubble in late 99, early 2000. So what does that mean moving forward? Well, because valuations in the US are so high, we would expect typically what happens is you'll have regression in the mean. You'll typically see those PE ratios over time tend to come down more closer to their long-term average. And US stocks are more highly appreciated relative to their long-term average than they've pretty much ever been. So we would expect more muted returns from US equities moving forward. Not saying we're going to get negative returns, but I would say relative to their long-term historical average, we would see lower returns moving forward. Now, looking at international stocks, their PE ratios are roughly in line with kind of their long-term average. So relative to US stocks, we'd expect higher returns from our international stocks. And maybe we're seeing that shift in real time, as obviously we saw a huge return from international stocks the first half of 2025. This could be the start of a good long bull period for international stocks versus their U.S. counterparts. We won't know until after the fact, but I'd say looking forward, our capital market assumptions are forecasting higher returns from our international and emerging market stocks relative to our U.S. stocks over the long term. Obviously, not saying over the next year, over the next 2 years. This is really more looking over the next 20, 30 years. We would expect that to happen. Now, last but certainly not least, just wanted to go over some of the returns of some of our liquid alternative strategies. We have a number of clients that have gotten good traction from their alternatives portfolio, and it really comes from a diversification standpoint. All of the strategies that we are recommending to clients have either low or no correlation to kind of traditional equity and fixed income assets. So it's a great way to diversify your portfolio. But also there's a nice return that comes along with these. We project over the long term, these will kind of have returns in between equities and high quality fixed income. So you can see what they've done year to date. Reinsurance is up about 3%. We have two kind of private credit strategies here, a middle market private credit and then a consumer private credit strategy. Both of those are up 4.5% and roughly 3% respectively. And then we also have a market neutral strategy that's up about 8% this year. And then, of course, global stocks up about 10%, global bonds up about 3%. Now, that's great when markets are doing well. It's a lot easier to look at these returns, but when alternatives, I think, really make a big difference is when you have either equities or fixed income suffering through a poor year. For example, 2022 was unfortunately kind of the worst of both worlds when we had poor returns from not only equities, but we also had very poor returns from fixed income. And you can see here during that period, while reinsurance was slightly negative at negative 3.4%, the three other strategies were up a decent amount. Private credit was up 6.5%. Our consumer private credit was up about 2.5%, and then market neutral did really, really well, being up 15%. So that kind of combination of those four components there actually provided a decent amount of stability in the portfolio when you had your two primary asset classes, stocks and bonds, performing pretty poorly. So if you want to learn more about those, obviously don't hesitate to reach out to your advisor. We can certainly do a deeper dive on those, but wanted to put those out there as that's another great way to kind of diversify portfolios if you're kind of worried about the long term or just want to take some risk off the table as you're maybe a little bit worried about what's going on in either the equity or fixed income market. So with that said, I will stop there and I will turn it over to Q&A.
Okay, thanks, Brian. Very helpful. We do have one question. You spent a little bit of time looking forward, and this one may be even looking a little farther forward, but we have a question about the recent passage and signage of the One Big Beautiful Bill, and maybe the effect that may have on asset allocation and things as the provisions of that are implemented.
Sure. Yeah, obviously there's been a lot of press about the passage of that bill a couple weeks ago. So I'll answer kind of the second question first as far as asset allocation. Short term, moves like this are, we wouldn't recommend making any changes to your allocation based off of a piece of legislation or anything like that. We would say you want to stick with your well thought out plan that you and your advisor agreed to and set forth. Now, what I will say about that bill is certainly there are some concerning things long term for the U.S. economy. Obviously, looking at that is expected to increase the debt to GDP, fairly substantially. Now, I will say, even if this wasn't signed into law, the way we are currently spending is unsustainable. It still would have put us in a pretty rough situation. So I would expect, there's going to be larger deficits moving forward. The debt to GDP ratio will increase. And at some point, we won't be able to kick that can down the road any further. At some point, there will have to be some kind of reckoning. What that is, I don't know, but at this point, the market does not look at that bill as a huge negative in the short term. In fact, it's actually probably expected to, in the short term, provide actually some economic growth, as obviously we're locking in the tax cuts that were signed into law in 2017. We're making those permanent. So in the short term, it's actually probably more beneficial to the economy. But long term, certainly we want to take into account the debt to GDP. And because the ballooning debt to GDP, that's also likely going to push long-term interest rates higher over the future. I've seen some estimates, it could be versus kind of what it naturally would be. Interest rates could be, about 120 basis points higher than they normally would if the bill wouldn't have passed. So at some point we will have to deal with this, but in the short term, I would not recommend making any changes based on the passage of this bill. But I certainly agree. I am concerned about the long-term debt of the U.S., and at some point we will have to deal with it in one way, shape, or form.
Okay, thank you. Just a reminder, if you do have any additional questions, please post them in the question and answer. We'll hang on here for another minute or two. If not, we'll wrap up. Just again, thank you, Brian, for the time and expertise that you've spent. It was a good summary of the last few months, and then even looking forward a little bit as well. So thank you.
My pleasure.
Okay, it doesn't look like we have any additional questions coming in, so I think we can go ahead and wrap it up. Okay, thanks, Brian.
Thank you very much. And if you do think of anything, obviously don't hesitate to reach out to a member of the team, and I'm happy to answer those questions if you think of anything afterwards.
Will do. Thank you.